Welcome everyone, and thank you for joining me for session number 11 on day one of our Future of Private Investing Festival, which is on investing for income, the secret to steady revenue streams and sustained returns. My name's Alex Newman, I'm an associate editor at the Investors Chronicle, and I'll be hosting today's event, which is very kindly sponsored by Schroders. I'll introduce our brilliant group of panelists and jump into our discussion in just a moment. But before we do that, just a few quick bits of housekeeping. We've already had a good number of questions submitted to our experts, but if you do want to ask them one, you can still do so in the box marked Q&A on the right hand side of your screen. I'll aim to weave some of them into the discussion towards the end. And second, I'm told a recording of this webinar will be available later today after the event has finished. So that'll be available for 30 days, accessible through the same link you used today. So you have plenty of time to listen back to the discussion at your leisure. Other useful links, resources, and the feedback link can also be found above. So in the blurb for today's session, it highlights highlights the inability of savings accounts to provide anything like a decent inflation-adjusted income stream. So some flexible accounts, savings accounts, might now be offering about 1.5%, but if you factor in 9 or 10% inflation, which is what we've got there or thereabouts at the moment, then the situation is clearly much worse for those savers than it was even a few months ago. So anyone looking to secure a steady stream of income really has little choice but to consider investments as a source of sustained returns. In this session, we're going to talk about what investors can do to diversify their income, how different forms of income investing compare, and how they can manage some of the risks. But before we get onto that, let me first introduce our panelists. So in no particular order, we have Kanish Swarup, a partner and founder of Compound Wealth Planning, who helps individuals achieve their long-term income goals in retirement. Annabel Brodie-Smith, communications director at the Association of Investment Companies, who focuses on helping the public and private investors better understand the uses and features of investment companies. Stephen Pyne, founder and managing partner of Holden and Partners, which works with individuals to help manage their income in retirement. And he has a particular focus on sustainable investing. And last but not least, Sue Nofka, head of UK equities at the asset management giant Schroders and manager of the group's Income and Growth Trust. We're going to kick off things today with a short presentation from Sue on our topic before we come back to a broader panel-wide discussion. So over to you, Sue.
Thank you very much. Well, you can see a potted history, my CV there. I've got over 30 years experience in managing UK equities, and I started managing income briefs over 10 years ago with the managership of the Schroder Income Growth Fund PLC. And more recently, I picked up some other retail funds in the income space, Schroder UK Alpha Income Fund and the Cazenove Charity Equity Income Fund. Managed those for the last 2.5 years. I've spent all my investment career in UK equities and all of it at Schroders, and my background is in business and biochemistry at Aston University. What I wanted to spend some time today is really addressing the topic of today's session, which is investing for income and the secret to steady return streams and sustained returns, really using my experience with the investment trust that I run and focusing on UK equities. And the data I have managed to get is from Morgan Stanley, and it more or less dovetails with my time looking at UK equities and being in the city. So it goes back to 1987. I was an intern at that point. I went back to university to finish my degree. But this looks at UK returns. It's the MSCI. And it decomposes into two lines. So the green line is the price return, sometimes known as capital return. The blue line really illustrates that power of compounding. When you reinvest income, you get a much, much higher return. So something like 14 times your original money in total return. And that comes from reinvesting your income and for that growth to be expressed really through growing income. So these are the 35-year investment returns. And what I'm going to do is just look at the annualized returns over the same period, the same market. And annualized, that total return at the bottom is 8% per annum. And when we look at the different components, the long-term argument for income remains strong because dividends have contributed just over 40% of overall returns, with 3.7 out of that 8. The other components are the earnings growth. Now, dividends are quite often tied to earnings growth in terms of a payout ratio, and it's that growth that we're after. It's the growth in earnings and the growth in dividends, which when you reinvest them, gives that very powerful total return. What we spend a lot of time in markets and in the media talking about is the level of day-to-day volatility, that PE expansion or contraction, which is what markets are going through in 2022 so far. But over the long run, that turns out to be a very minor number by comparison to both dividends and earnings growth. Let's have a look at those income yields of key assets. Started this session talking about how little is available in, I managed to knock something. Here we go. We talked about how little was available in savings accounts. Well, here I've shown a few main UK equity indices against residential property, 10-year gilts, instant access, 10-year bond yields in the US and global equities. And you can see that UK equities, given in the pink red colour, remain a very good hunting ground for income seekers, with dividend yields or income yields of close to 2.5 for mid-cap stocks and over 3.5 for the larger companies. I would have to say that US bond yields have moved some way since this data was put together. It's the end of March for this slide, and US bond yields are about 100 basis points higher than that today. Dividend income does grow over the longer term, as we've been able to see, but anyone with of the last 15 years will remember how vulnerable dividend income can be to economic shocks. And I've put the two main ones here. The 2008 to 2010 global financial crisis saw dividend income fall by about 15%. Similarly, over the 2 years of the COVID pandemic, income has also fallen by about 15% from the market, although the falls in 2021 were much sharper over the first 12 months of the pandemic. What I wanted to go on to talk about was really how retail investors can take advantage of some of the ways of investing to protect and sustain the growth of income, the security of income. And I've put a number of advantages to the investment trust structure up on this page, but I'm only going to talk about one of them, and that's revenue reserves. Because an investment trust structure allows the manager to retain a portion of income generated each year and not distribute it. In the case of real estate investment trusts, that's 90% as a minimum has to be paid out. For other investment trusts, it's 85%. Now, what managers will do with that additional or extra that they retain is keep it in revenue reserves for use in tougher times. So coming on briefly to the investment trust I manage, the Schroeder Income Growth Fund, it has two aims: to provide investors with a growing income, and for that to grow ahead of inflation, a challenge, as we know, in current times, and to provide capital growth really as a consequence of that rising income. And I'm very proud that the dividend of the trust has grown each and every year since launch. And over the whole time period of 26 years, its dividend is over 80% higher than if it had just kept pace with consumer price inflation. Now, how do I do that? I look to balance the sources of income across a number of different aspects, to embed an attractive level of income from sustainably high areas of the market that I've chosen, and to blend that with some lower yields, but growing yields. So really looking beyond today's highest dividend payers to provide attractive levels of income today and into the future. And it's this ability to use the tucked away amounts into revenue reserves, which ensures that income to investors can be smooth and that the future growth is sustainable. The blue bars are the dividends per share, and the green bars are the retained revenue per share for the trust. And you can see that the blue has always gone up and the green has declined at various points as we've drawn on those in tougher times, such as the global financial crisis and COVID, to ensure that we can continue to smooth that level of income for investors today and into the future. And where we ended up at the fund's year end is the end of August. We have 10 months in reserve to ensure a bright future despite the storm clouds with inflation and markets. Thank you very much.
For that, Sue. I'm going to jump into questions in just a minute, but before we do that, I also wanted to highlight for everyone watching the poll we have on your screen now. Should be coming up, and it's a fairly broad question, but it's on is investing a part of your personal finance planning? So the options should be there if you click onto that, and we'll be coming back at the end to check in on the results of that poll. I'm also conscious that among our viewers there will be several different audiences with different sets of needs. So maybe let's start from first principles. So if you're in employment and have a salary that meets your day-to-day financial needs, should you be thinking about taking income from bond or equity markets, or do you think you should focus primarily on growing that? Sue, maybe if you could put that question to you, just to follow on from your presentation there.
So I think the first chart that I put up that showed the power of compounding, if you're reinvesting that income, is what to have first and foremost in your mind. If you're not needing to supplement your income today, reinvest it, because over the long term that will be a powerful driver for growth, and you'll be able to draw a bigger income from that higher capital value when you so desire or so need it.
Is your feeling as well when you're looking at companies generally that the companies that actually talk about dividends a lot are quite well positioned to grow and compound? It's in a way it's kind of a proxy discipline for their own ability to grow over the long term, or is that too broad brush a thing to say?
No, it's not. It's about what we call in the city capital discipline. And capital discipline is of what strength of balance sheet do you have? What level of investment do you need to secure your sustainable attractive future? And what do you need to reward your investors with to be part of that journey? And shareholder returns can comprise dividends, but also share buybacks. Sometimes, if your share price is weak because markets are weak, your sector's out of favour, perhaps it makes more sense to spend the amount of money or part of the amount of money you would normally pay as dividends to investors in share buybacks. But the discipline of constantly maintained or increased dividends applies to companies as much as it does to investment companies. That track record is something that people feel very proud of, and they want to ensure that they can maintain that.
Definitely. And I mean, it'd be good to unpack in this session some of the differences between companies and investment companies and how the two balance those income strategies. Kanish, if I can come to you, I mean, Parkinson's law states that no matter how much money people earn, they tend to spend the entire amount. What's your feeling on this? Does a kind of a focus on monthly income, if you have it from your investments, create a kind of addiction to individual income streams? And I guess, in other words, what are the pros and cons of taking income, assuming you have other sources of income to draw on?
Yeah, I think it's a really good question, right? And I think, having worked with so many different families over the last 5+ years, what I find is, if you have a steady work income and you have enough disposable income to support your lifestyle and pay for all your bills, etc., then I think the optimal strategy is to not take income physically in your bank account, but to kind of reinvest that income back into your investment, so that the power of compounding can make your pot grow bigger. So I think the focus there should be more on total returns, i.e., how much capital appreciation you're having in your investment, plus how much income is it generating to give you that total returns, rather than just focusing on that income element and actually taking into your bank account. Because, as you rightly pointed out, once the money comes into your bank account, the tendency is to spend it rather than to save and reinvest. Having said that, interestingly, I find people and individuals in the older age group, so let's say if I was to say in the 40 to 60 age group bracket, what I find is that they do need a supplementary income to, let's say, support their lifestyle and their spending. And for them, I think it definitely obviously makes sense to take that physical income to pay for whatever they need to pay for. And in fact, I find that to be quite powerful, because it kind of encourages them to kind of to invest further. And I think I'll finish that point off by saying that everybody is attracted to, in general, buy-to-let investments, buy-to-let properties, because of the fact that you get a physical rental income coming into your bank account every month. And that convinces people that in order to create a passive income, that is what they need to do. And I think the answer is that is one of the options. But let's say something like the fund, like this, for example, the Schroders fund that we are speaking about today, or other funds that exist, also give you a good alternative. But in order to convince people, I think we need to kind of see them get their revenue stream in their bank accounts to feel confident about it.
Yeah, and I suppose without tying up so much capital that buy-to-let or property portfolio investing often requires. I totally take the point there, Kanish. And obviously, the drawdown phase of anyone's investing is a case-by-case basis. What you're going to need is a matter of your personal circumstances. That all said, Steve, I mean, should someone approaching retirement look to move their income generation into bonds and properties, as opposed to equities? I mean, that the slide that Sue put up on the way that a trust can smooth the distribution profile over time is kind of a function of having cash on hand, isn't it? But within those periods, there are big wobbles in the dividends that the stock market can provide year to year. I mean, obviously we had 2020, 2008 were instances where it really crashed off a cliff. What's your feel? Is it bonds and property or equities, or is that too?
Well, it's a very important
much
point.
of a distinction that investors shouldn't worry about.
Yeah, I thought it's a very important point. Obviously, I think it comes down to individual circumstances and objectives, and what the financial plan is, and what an individual's attitude to investment risk is. It depends clearly on how much income they need. But I think we're moving away from a point whereby individuals are moving significant portions of their portfolio to more defensive assets, perhaps in retirement. Someone might be taking a retirement income for 20 years or something. So this is a very long-term position potentially, and a portfolio does need to be positioned for the long term. So I really think it comes down to a diversification of assets, which will include bonds, equities, and property.
Point taken, totally. Annabel, I wonder if I could turn to you on this one, and forgive me for playing devil's advocate slightly here. I mean, what would you say to those who might argue that dividends, either at a company level or structures which focus on paying out 85% or 90% of income generation as cash, are really a distraction or a poor use of capital, and that anyone who's managing that money, be it a company executive or a fund manager, should really always be thinking about finding new opportunities for capital investment, or buying back their shares if they're trading at a discount, and rather than giving the cash away, because every investor can do that by drawing down themselves. What's your take on that?
Yeah, well, there was a rather cheeky hedge fund manager who described the UK market as being a bit like Jurassic Park, because there was so much emphasis on income investing. And I have to say, first of all, of course, he's talking his own book there. Of course he is. So we need to really bear that in mind. But also, we are meeting investors' needs. And it's all very well to say everybody should invest in growth stocks, but inevitably then you've got the hassle of selling them, finding the right time to sell them, paying those brokerage costs. Inevitably, when you want to sell them, the market has collapsed. It's just not realistic for income investors. And I have to be honest here. I think our advisors have explained it very well. But a lot of people who are taking this income, they need it. They're not taking it for fun. They need it to support their lifestyle. It's a great wealth asset manager I know, Bruce Stout, who manages Murray International. And he says when he thinks about which companies he's going to invest in, he thinks about his shareholders and the fact that they are relying on those dividends to pay their bills, to pay their gas bills, rather large gas bills in the current circumstances. So I don't think that's at all realistic. I also think that actually lots of investments are now investing in lots of very innovative types of investment. So, for example, renewable energy infrastructure generates a very strong yield, as does infrastructure. But, UK and global equity income are important cornerstones for income investors. And I don't think we should get carried away by, as I said, hedge fund managers who want to talk their own book.
Yeah, I think it was Marshall Wace, wasn't it? Or I might have got that wrong, who made the that Jurassic Park intervention. Maybe could sort of throw that back to you, actually, Sue. I mean, given you've spent your career focusing on UK equities, that's sometimes the criticism, isn't it, from the US that UK or European markets are overly focused on dividends, supposedly beholden to pension fund managers. I mean, obviously the points that Annabel makes about the security that ordinary retail investors need shouldn't be overlooked. But what's your take on that? That, the US seems a little bit more averse to dividend distributions, and that's a market that's not short of amazing companies.
Yes. the US market has typically favoured share buybacks that can help boost earnings growth. And again, talking about people who are suiting their own book, quite often management are remunerated by earnings growth. So no surprise there that certain managers of companies are pulling the levers that reward them the most. But having said that, sometimes share buybacks, as I've discussed, if the shares are lowly valued, it makes a lot of sense to buy back shares. The problem with some markets and some companies is that they get carried away, they're flush with cash when they're doing well, and the share price is much higher, and it's less accretive, shall we say, less rewarding. I do think that the Jurassic Park comment kind of rang the bell. So it is worthwhile noting that the UK equity market composition has served it very well in 2022, when we've had much tougher environment for asset markets. And the UK equity market, I think, is having its best start to a calendar year for over 40 years. So actually, some of those higher income yielding or generating stocks have been the best performing so far, not just in the UK equity market, but across equity markets. Income and low valuations have been the place to be, to not suffer from the same magnitude of falls as some of the higher valued assets, such as US equities.
Kanish, I suppose a product of that is, or a cause of that is, this high inflationary, rising interest rate environment we all now find ourselves in, and that some of the price setters, be it commodities, oil and gas firms, are doing very, very well out of this inflationary environment. Thank you. How do you, when you're speaking with your clients, explain the balance between income and inflation and interest rates, and what is the right answer to all of this at the moment? Please solve our monetary, financial markets question in one sentence.
Well, I think the key is to have a structured plan, right? So I think whilst we talk about income and growth, and we talk about UK and US and asset allocation, we need to kind of start with, where are you today? What is the priorities and goals that you have for the next 5 years, 10 years? Is it capital accumulation? Is it taking an income? Is it trying to retire early? Is it trying to fund your children's education? And then based on that, we can really objectively define what the timelines are, and how we invest will kind of depend on that. Fundamentally, in the environment that we are in right now, as you started this conversation today, inflation is running at 8 to 10%. So if you've got surplus cash, surplus savings sitting in your bank account earning 1% or 1.5%, you are guaranteed to lose 7%, 8% every year, because the purchasing power you're going to lose because of inflation. So you have to be very, very proactive and structured about where you're going to deploy those savings, where are you going to invest them, in the anticipation and hope that you would be at least be able to generate something that matches inflation or beats inflation, and kind of stay where you are. So I think that's the starting point for me. In terms of the views about asset allocation at the moment, I feel everything is linked to inflation right now. And I think a lot of the inflation that we are experiencing in the markets are due to two main factors. One is due to the lockdowns in China, which have been far more stringent than anybody expected. And secondly, the conflict in Russia and Ukraine. Now, hopefully, over the next 6 to 12 months, these supply side constraints will resolve itself, or things will get better, which will hopefully cause inflation to calm down, and interest rates can stop going up, which should generally be good for all asset classes. But again, diversification is key, right? Nobody would say that having all your money in property, or having all your money in growth companies, or having all your money in income portfolios is the right strategy. But there has to be a mix, and the mix will depend on, I guess, how much risk you can take and what your timelines are.
Completely. I mean, on that point, Annabel, I mean, we've spoken a little bit about in Sue's presentation how she breaks down some of the sort of steady, reliable dividend payers, the growth companies, and also some of the higher dividend payers. I mean, some income investors are going to be a little bit nervous that the times are looking very good for some of those big dividend payers at the moment. What are some of the other options out there in investment company or investment trust world, which perhaps balance that concentration risk a little bit that perhaps we see in the FTSE 100?
Absolutely, Alex. Well, I think Kanish is absolutely right. Can I say it really is time for a diversified all-weather portfolio, and investment trusts can give you some other options. So, for example, and a lot of those actually give you inflation-linked income, which is particularly important when we've got 40-year highs of inflation right now. So, for example, the infrastructure sector, for example, relatively stable, reliable asset, very long-term contracts, and inflation-linked income for some of the companies. So I talked to two of the big infrastructure companies on Monday. I was talking to their managers. For every 1% increase in inflation, they were getting a return of 0.7 or 0.8%. So they are highly linked to inflation and therefore, pretty resilient. Another option, we could look at renewable energy, talking about more innovative assets, investing in wind farms and solar parks, battery storage. We've even got one company invested in hydrogen. And obviously in an inflationary environment where obviously energy prices are increasing, we want a greener and we want more self-sufficiency. Energy self-sufficiency, very important. I think the war in the Ukraine has really highlighted that. Another very sensible option. And, these have got considerable yield. So, for example, infrastructure is yielding 4.6% on average. The renewable energy infrastructure sector is yielding 5.3%. Then we could, of course, look at property, which had a very, very tough time through the pandemic. But it's really bounced back very strongly. It's up 6% in 2022, up 18% over the last year. And it's still available on very wide discounts, which means, the shares trading lower than the actual value of the assets. Clearly, maybe there's some concern because obviously it looks like we're going into a recession, but having come through the pandemic and, total lockdown, I think property is also another option, obviously defensive in the inflationary environment.
Yeah. Steve, I know you've talked about a little bit about the sustainability options for investors. I mean, some investors might look at Rio Tinto or Glencore or Shell or BP and say, look, I don't want to be investing in these companies, but I still also want a reliable income stream. Annabel's touched on some of the renewable funds or subsectors there, which are yielding quite strongly. What are some of the other options that you would be pointing your clients towards when if they came to you with this sort of brief?
I think, Annabel's pointed out a few of the more obvious alternatives there. So, for example, our sustainable and ethical clients have been invested in renewables for 5 or 6 years now, and they have paid a very healthy income stream. But I think it sounds sort of fairly sort of rudimentary and boring, but even if you're a sustainable investor, it comes down to having a balanced and diversified portfolio. So you might not be investing directly in an oil company, for example, but you will have exposure to the UK market. So it comes down to having the right asset allocation for your risk profile. But I wouldn't.
What's your take then on?
Yeah,
sorry,
on. Sorry,
Stephen.
No, I don't think you can sort of pin down specific sectors. I think that's the wrong approach. You need to look at it from a sort of top-down approach as an advisor.
Okay, absolutely. I mean, one of the top-down questions, Kanish, that I suppose people have is around the bond equity balance within portfolios. I mean, this year it looks like the correlation has broken down a little bit. I was looking at some commentary this morning, suggesting that before the financial crisis, and in the decades before, it was almost taken as axiomatic that bonds would yield more than equities. Do you see us returning to a similar picture for markets and how that affects the way investors structure their portfolios?
I think for me, it's about focusing again on I think just looking at the yields of fixed income versus equities doesn't give you the full picture. So you need to kind of take into account the total risk that you're taking. What is the risks involved in investing in bonds? And what is the risks involved in investing in equities? And on balance, equities is definitely a riskier asset class. But then on the flip side, it comes with the potential to make higher returns. Whilst in a bond, I guess the returns are more stable. And you're not likely to get those exponential returns that you can sometimes get with equities. So I think the answer about the balance between equities and bonds, in my opinion, for an individual investor who is trying to invest for the 5 to 10 year time horizon, depends more on their own risk appetite and is the focus on wealth creation, in which case I think equities, a more equity heavy portfolio is more suited, versus is the focus more on wealth preservation, in which case I think a bond heavy portfolio is probably more sensible given the income streams are more stable. So I would be more driven by that aspect rather than trying to get too involved in what's happening, let's say in the last 6 months or 5 months, because to be honest, it is too small a time frame compared to what we are investing in.
Yeah, a very, very good point. I mean, it's a preoccupation of a journalist to be focused on micro timeframes. Sue, if I could jump back to you, I mean, talk us through, as an asset allocator yourself, in that you're both managing the cash distributions and also the reserves within a trust. What is your priority this year? Is it to juice dividends because you're aware that the cash distributions are not quite going as far in a higher inflationary environment for some of your shareholders, or do you look to hold back a bit of cash even though there's a bit of a drag given some of the risks maybe that are ahead?
Well, we might be getting ahead of ourselves because there's still some recovery from the pandemic to be had. And again, the trust that I run doesn't have a calendar year. So when I'm talking about the year for the trust, it's through to the end of August. So that is, in the main, a lot of those final dividends that have been paid for last calendar year, 2021. So I think this year will still be an element of pandemic catch-up, and it's balancing the income today, using the revenue reserves to make good, rather than overreaching potentially for those higher yields, which may not be the right balance for the portfolio and for the investors in the portfolio for the medium and longer term. And to make sure that I'm able to allocate to those most attractive opportunities. And we'll all know that certain sectors were harder hit than others in the pandemic. And just a couple of leisure names that we've held in the portfolio that we think are emerging stronger, picking up more market share. It would have been wrong of us to have sold those just because they weren't paying dividends for a couple of years to try and then buy them back later. So we've taken a much longer term view and balanced those different sources, and only sold out of holdings where we felt that the valuation was full or the risks were really mispriced and there was downside to be avoided by selling?
Right, good stuff. Just to change tack slightly, Annabel, one thing we've not touched on is some of the, I suppose, the tax benefits which are associated with investment companies or investment trusts primarily at the ISA level. I imagine for lots of people who are watching this webinar. Can you talk us through some of the ways that income can get that extra kicker from the way investment trusts are tax structured?
Yeah, well, obviously, you're quite right there. The ISA is really the key element for most people. Most people, if they can, they will have their full ISA allocation, the £20,000, and they will hold it in an investment company. And also then, obviously, you've got tax-free income, tax-free growth. You don't have to worry about capital gains tax. And that makes a lot of sense for a lot of investors. Other investors might hold their investment trust in a SIP, in a self-invested personal pension, again, to get all those tax-free benefits of the pension wrapper. We also, in the investment trust world, have venture capital trusts. Now, these invest in smaller, high-risk, young companies, but they come with, you're taking on quite a lot of investment risk. But as a result, they have tax-free dividends and also 30% upfront tax relief if you hold those shares, you buy it when they're issued and hold for 5 years. And it's interesting that also we've seen a lot of investors interested in this type of investment. Clearly, those are very attractive tax benefits. They also like the fact that they're investing in young companies, helping the economy post the pandemic, helping entrepreneurs. This year we actually had a record year. We raised over £1 billion. We've never raised over £1 billion before for venture capital trusts. So those are some of the ways that people are holding their investment trusts and make full benefit of the tax advantages.
Thanks for that, Annabel. That's really handy sort of how-to and some of the tax elements of investment trust investing. I'm just going to jump into a couple of questions that have come in. Thank you for all of your questions so far. There's still time to send a few more in. Let me turn to this one, and maybe Steve, I can ask you to answer this one. Someone's written in saying, you've talked about reinvesting income when working. Please, could you cover how best to generate income when you're retired? So let's imagine there, I suppose, that someone is beginning afresh in their income investing portfolio construction, and they are retired. What's the kind of starting point for someone who may not be taking a salary anymore, Steve?
Yeah, I think ideally you would have sort of the first 12 months income in cash, so that you can allow the portfolio to bed in and the dividends to compound. And then, it's the same message again, but it will come down to the individual's appetite for investment risk, what their objectives are, and what their time horizon is really. So it's putting the plan in place first and then going from there. So they might have a higher degree of exposure in income producing assets, and perhaps that's going to be the starting point. But again, it's going to come down to the attitude to investment risk and the financial plan.
And another one we've got here, Sue, I might put this one to you, given as you look at lots of the global UK headquartered but globally facing dividend payers. Should an income investor prefer global equity income or UK equity, considering likely value of GBP over the next few years? So I suppose the question there is, are currency considerations important? And I don't know necessarily what the likely value of the pound is over the next couple of years. It's not been doing great. Should investors factor currency into their income investing calculations?
I think it is quite important. So sterling has been weaker. Partly it's the weakness of sterling, partly it's the strength of the dollar. The dollar has been strong against all other currencies. It's the safe haven, and that's where the inflation fighting rigor seems to be being fought the strongest. Now, if I look at the numbers on the chart that I put up earlier, UK equity income pays more than global equities or US equities, probably about double if you take the wider markets. UK stock market is not the same as the UK economy. And in fact, about 3/4 of revenues are derived from outside the UK. So there's already an exchange rate element in revenues, in profits, and often in dividends. Some of those individual investors who own individual shares in some of those larger cap companies will find that they have companies that declare their dividends in foreign exchange, usually the US dollar, but can be the euro. And then there will be an exchange element applied, so they'll receive in sterling if that's what they want. So there are already elements baked in, and as an allocator within the trust, I take views as to the attractiveness of individual companies, knowing where exchange rates are and having a view as to what are the likely influences on exchange rates.
Okay, thank you for that. Final question I'd just like to end on, given as we've got a couple of financial advisors with us. What are, Kanish, some of the pitfalls or errors people make when it comes to income investing? Are people generally realistic about their income prospects in retirement? What's your thoughts on that?
I think I've seen both scenarios playing out equally, right? So one scenario is where people, it's like ignorance, right? They kind of expect that in retirement they would have enough income, and they kind of continue on the same trajectory of spending based on today's income, without realizing that once their work income stops at some point in their retirement. And retirement, traditionally people retire at, let's say, 55, 60, but they're living now till 90, 95 plus. So you've got a 30-year period to kind of plan for. And I think a lot of people do not realize how long a time that is, and hence undersaved during their working years by overspending on like cars, homes, etc., and then finding things hard in retirement or not being able to retire when they thought they would. But equally, I find a lot of people who are very, very money conscious during their working careers, oversave and live very conservatively, only to reach their 70s and 80s to realize that I wish I had taken more time off work, or I wish I had done the things I really wanted to do, because I've got all this money, but I don't have the health or the time to kind of enjoy those things. So
Yeah.
I guess for me, the lesson here is, I think when you're thinking about income, I would say 90% of the people probably end up spending 90% of their time focusing on their work income, their career income, their business income, whilst completely ignoring the aspect of kind of generating that passive income. So the starting point is actually finding the time. So you need to find the time to actually think about these things in a more structured manner. And if you don't have the inclination, then outsource it to somebody who can do it for you. And then that will give you kind of the framework to create those assets whilst you're in the accumulation phase. So your pension could be one asset, your property could be one asset, your ISAs could be one asset, and you build them up as much as you can in the most tax efficient way. And then when you reach that retirement point, again, tax has to be taken into account as to which assets to draw money from first to have a comfortable lifestyle.
Sure. Thanks for that, Kanish. Well, I mean, just to, before we close out, tie in the results of our poll, which I suppose speaks to that a little bit. So is investing a part of your personal finance planning? The question we put there, quite a broad one. No one said that investments aren't part of their broader financial planning. We've got 30% saying I use my investments to supplement my income. 3 say I use investments to prepare for retirement. Sorry, 60% of people say I use investments to prepare for retirement, and 10% plan to pass their investment returns to future generations. I suppose the last 3 there aren't necessarily mutually exclusive, but interesting to see where the balance lies. But that's pretty much all we've got time for today, I'm afraid. So just to remind you, this session will be on demand for 30 days on the webpage you're currently watching this on. So feel free to share it with your network, your friends and family, if you found it useful. Thanks again to my panelists, Kanish, Annabel, Stephen and Sue, for your insight. Thanks again to Schroders for sponsoring today's session. The next session with my colleague Dan Jones begins at 4:05 and is on risks and costs in the world of emerging markets. Other than that, it just leaves me to thank my guests one more time and to all of you for watching.